Welcome back to Monkeynomics. This lesson is going to be about the differences and purposes of buying and selling individual stocks, mutual funds and ETFs or exchange-traded funds, as well as constructing a portfolio based on your risk tolerance and how to evaluate said portfolio. However, before we get into today's lesson, I've had several questions from the last lesson in regards to market cycles and my disdain for index investing. First, let me say that if you simply want to put your money in something with little to no fees that will do reasonably well and that you don't have to think too much about or spend too much time maintaining, you could do much worse than an index fund. However, you are really costing yourself a lot of potential money by being so lazy. If you're too busy to do things yourself, hire someone to manage your money for you. If you're worried about the fees eating into your profits, move only a small portion of your money into something managed and see how the managed account does in comparison to your index fund. If the manager is earning higher returns than the index fund, even accounting for their fees, which will be only around 1% a year, then they're worth it. However, this isn't as difficult to do yourself as people think. Let's briefly examine how a sector rotation strategy works, using the last 10 years as an example. There are 4 cycles to the market, just like there are 4 seasons in a year. Each cycle, just like each season, follows the other. Now, when you think about the cycles like the seasons, you can make logical predictions. Which season would you expect to sell more ice cream? Summer, because it's hot. Which season do you expect to sell more toys? Fall, because people are buying toys for Christmas. So let's say you bought stock in ice cream companies in the spring and sold them in the summer, or bought toy company stock in the summer and sold them in the fall. Makes a lot of sense, right? This is what sector rotation is, except instead of watching the weather, you watch the markets and the economy. Just like summer increases ice cream sales and fall increases toy sales, each cycle favors certain industries. Some industries even benefit when the economy is bad, or at least lose the least amount of money. So let's go over the 4 cycles and which industries benefit during each phase. The recovery or market bottom phase. This is the phase of the cycle when the economy has just begun climbing out of the recession. The industries that benefit most are financials, i.e. banks, technology, and consumer discretionary, which is just a fancy name for non-essential or luxury goods and services. These include retailers, media companies, clothing brands, and automobiles. The boom or bull market phase is the phase of rapid growth when the idiots jump into the market and start buying shit they don't understand and creating a bubble. The industries that benefit most are technology companies, industrials, i.e. manufacturing, construction, and machinery, and basic materials, which means companies that process raw materials like mining, metals, chemicals, wood, etc. Notice that technology is prominent in both the recovery and boom phase, so you want to sell it last because it may still have room to grow during the early stages of the boom phase. The peak or market top phase, this is the phase where the economy is at its peak more or less. This is when the rich people sell and the broke people buy. The industries that benefit most during the peak are energy, meaning oil and gas companies mostly, but you can invest in solar and wind if you're an environmentalist or have a problem investing in oil companies. The other winners are utility companies, which are usually related to the energy sector anyway. And once again, basic materials makes an appearance as the transition sector. The bust or bear market phase. Finally, we have the hangover phase after the party. Nobody likes a market crash, but you can make money in any economy, or at least limit your losses. A lot of people cash out during the peak and get back into stocks once the recovery starts. But you can often make money even during the recession if you know which industries benefit from the bad economy. And they are utilities, consumer staples, which simply means essential goods like food, cleaning products, etc., and healthcare. As I mentioned in a previous video, even when the economy is in the toilet, people need electricity, people need food, and people need medicine. Now that we understand the basic concept, we need to test it. Sector rotation seems almost too easy, right? If it's this easy, why doesn't everyone do this? The reason is that most managers have investment objectives, so they can only invest in certain companies. The exceptions are hedge fund managers, which do use strategies like this. None of what I'm telling you is a secret or something I came up with myself. Looking at the last 10 years from 2004 to 2014, we can identify a complete cycle during this period. Now, it's important to recognize that the economy can still be in a recession while the stock market is in recovery. Technically, the stock market was in a recession from 2008 to 2012, because 2012 was when the market fully recovered. But you can't judge a market cycle based on the overall recession. When the market begins going up, you're now in a bull market. The recovery has begun as far as stocks are concerned, even if the recession is still ongoing in the general economy. So once you recognize what phase of the cycle you're in, you know what to buy and what to sell. If you're just starting out, just buy what you know will go up later and don't worry about selling anything until the cycle loops back around. When selling, stretch out the sales across a few years in order to limit your tax liability. And if you don't sell everything before the cycle turns, just hold on to it and sell it next time. The cycle repeats itself about every 10 years or so. This isn't a get-rich-quick scheme, as it will take you about 10 years to go through the complete cycle. And you can see the S&P 500 in blue, which didn't do bad. If you simply put your money in an S&P 500 index fund, you'd be doing okay, basically staying in the middle of the graph. So if that's good enough for you, that's fine. However, with just a little bit of extra work, you can make significantly more than the market. Okay, so I hope that cleared things up regarding market cycles and sector rotation investing. Now let's move forward and talk about the three main ways to buy stock, which are buying individual stock, buying mutual fund shares, and buying an ETF or exchange-traded fund. The easiest way to buy stock is to buy a company stock directly off of a stock exchange. If you want to own stock in a specific company like Apple, for example, you would want to buy the individual stock. Since you own the stock without involving any managers or middlemen, there are no fees and expenses like you would find in a mutual fund other than the trading fees. There may also be custodial fees if you keep the stocks with your broker for safekeeping. The primary disadvantage of owning individual stocks is that it's extremely unlikely that you'll have enough money to be properly diversified. The average stock in the S&P 500 is about $70, with some like Google and Apple costing several $100s for a single share. If you wanted to be properly diversified across an entire market sector or sectors, you may not have enough money to be properly weighted. Another disadvantage is that without any management, you'll have to be knowledgeable regarding all the companies that you own to at least some degree. Most mutual funds have research teams that specialize in a single sector or class of stock. It's very doubtful that you'll be able to be knowledgeable enough to keep up with even a fraction of the companies you own, assuming you can even diversify yourself properly. My advice regarding individual stock is to only buy the stock in companies that you want to own because you're interested in the company itself. If you want to own Apple and you're willing to pay over $700 for it, go nuts. However, if you want to own a piece of a technology sector, for example, owning individual stock is not the best way to invest broadly. Now let's talk about mutual funds. A mutual fund is basically a pool of money that allows a large amount of investors to achieve more than an individual investor could. The investors pool their money and thus mutually fund the portfolio, hence the name mutual fund. Mutual funds are run by a fund manager that sets the objective for the fund and chooses the companies to buy and sell. The types of companies the fund is interested in are usually indicated in the name of the fund. For example, a mutual fund named Large Cap Growth Fund invests in large cap companies with high relative earnings. You'll see the words growth or value within many mutual fund names. A growth fund invests in companies with high relative earnings, which indicate that the company is growing. A value fund invests in undervalued companies as calculated by their earnings and share price. Value funds tend to be less risky than growth funds, even within the same asset class, but may earn less than their growth counterparts. Buying a share of a mutual fund allows you to own a relative percentage of the entire portfolio, which allows you to own a stake in hundreds or thousands of companies depending on the fund for a fraction of the price of trying to own these stocks on your own. Mutual funds also offer professional management and research for a fraction of the cost of hiring a private money manager or research team yourself. The downside of a mutual fund is that the fund charges fees in order to pay for the fund manager and the research team. These are usually around 1% but can be higher, but are rarely more than 5%. Generally, the more volatile the asset, the more research required, the higher the fees, which are known as the fund's expense ratio. However, remember during our previous lesson I mentioned that if the asset was stable, you could take a passive approach, which is represented by a lower expense ratio. An index fund is an example of a mutual fund, and because the assets are very stable and can be managed by a computer and not a human being requiring a research team, and this is why index funds have extremely low expense ratios. An alternative to a mutual fund that provides the same diversification benefits without the management expenses are exchange-traded funds or ETFs. These are baskets of stocks that are sold as a single stock, like a mutual fund share. But unlike a mutual fund share, they can be purchased on an exchange rather than purchased and redeemed with the mutual fund company directly. Because they are bought and sold like any other stock, you can sell them short, you can buy them on margin, and there are no minimum purchase requirements. Another advantage of ETFs over mutual funds is that there are no managers, so the expense ratios are even lower than comparable index funds. ETFs work best for passive assets like large cap or stable sectors that don't require active management. Mutual funds work best for volatile assets that require research and management, but be aware that these funds will have higher expense ratios, and those fees will come out of your returns. The final goal is to create a portfolio based on your risk tolerance. There is a relationship between risk and reward, so if you want to lower your risk, you must also lower your expected returns. Once the portfolio is constructed, you want to pay attention to the 10-year average return and the beta. The 10-year average gives you the return averaged across the last 10 years. Let's say your 10-year average is 10%. That doesn't mean the portfolio earned 10% every year. It could have made 5% one year, lost 5% another year, and made 20% the third year. However, when all returns are totaled and divided by 10, the average return is 10%. So understand that due to volatility, the returns may be higher or lower than the average in a given year. The beta is a measurement of risk or volatility. Without getting too technical, it measures the volatility in comparison to the market as a whole. I'll include a link to an Investopedia article if you want to get deeper into what beta is, but it's not hard to understand in practice. A portfolio with a beta of 1 is as volatile as the market as a whole, and will essentially move with the market. A beta of less than 1 means that the portfolio is less volatile than the market. A beta of more than 1 means that the portfolio is more volatile than the market. Here's a general rule of thumb regarding 10-year averages and beta. Your goal should to have a beta that's correlated to the 10-year average. A conservative portfolio should earn about 6% a year, and have a beta of 0.6 or lower. A balanced portfolio should earn between 7% and 8% a year, and have a beta between 0.7 and 0.8, so on and so forth. And then aggressive should have a 10-year average of 10% a year or better, with a beta of 1 or less. This goal isn't always attainable based on the market, but that should be the goal. Some questions you might be asking are, why would I want a lower return? Or what does the beta mean in practical terms? Think back to the 2008 recession that lasted until 2012, when the markets recovered to their pre-recession highs. 2008 to 2012 was 5 years. If your portfolio's beta was 1, it would take your portfolio to recover from its 2008 losses 5 years as well. If your portfolio's beta was 0.5, or half the volatility of the market as a whole, your portfolio would have likely recovered between 2 and 3 years, or about half the time it took the market as a whole to recover. In exchange for this benefit, the portfolio earns less on average, about 5 to 6 instead of 10. So if you have a lower risk tolerance, you have to judge whether you prefer to make more money in the long term, or if you prefer to recover from a recession quicker than the overall market. You can't have it both ways. If you want to increase your returns, you have to accept higher risk. If you want to lower your risk, you have to accept lower returns. You should always be beating the market one way or another. Either your returns should be higher or your beta should be lower, preferably both. Otherwise, you might as well just get an index fund. If you're not beating the market, your manager or your advisor needs to be fired. If you manage your own money, you might want to fire yourself and find a decent manager or advisor. So I mentioned some portfolio models in the last lesson. These are good starting places, but they're only starting places. So let's take the aggressive portfolio model and build a quickie portfolio. The aggressive model consists of 50% large cap stock, 25% international stock, 20% small cap stock, and 5% in cash. Large cap is a stable asset, and since it's the majority of our portfolio, let's create an ETF portfolio. This will keep our expenses low. International stock is more volatile, especially with small companies. You could go with an ETF or a mutual fund. There are also ETFs for individual countries or regions, but for simplicity, let's use a generic international stock ETF. Small cap is generally too volatile for an ETF in my opinion, but since we've been using ETFs for the other assets and this is just a quickie portfolio, let's use a small cap ETF as well, just to keep our fees and expenses down to a minimum. Let's also roll that 5% in cash into the small cap, increasing it to 25%. So we're only dealing with 3 assets. Okay, so I'm going to show you how to do these calculations for free using Google Finance. I prefer Morningstar, but it costs a lot of money to have access to their tools. So I'll show you how to do it manually. If you want more advanced tools, you'll just have to pay for them yourself. So I created this graphic using 3 ETFs taken from Google Finance. I redacted the company name and ticker symbols because I don't want to be seen as recommending any particular investment company. You can see the beta directly on the entry itself, and you can calculate the 10-year average by clicking the 10-year zoom button and dividing the return by 10. Since our portfolio is 50% large cap, we must double both the beta and the 10-year average returns for that asset. Add up the betas, divide by 4, and you have the portfolio beta based on our simple allocation of 50% large cap, 25% international, and 25% small cap. We do the same with the 10-year averages by adding up the averages, dividing by 4, which gives us the weighted average 10-year return for the portfolio. The beta for the portfolio is 1.1025, which indicates that the portfolio is more volatile than the overall market. The 10-year average for this portfolio is 8.63125, which is lower than we would expect from a portfolio with this risk. However, when we look at the S&P 500 index, the 10-year average is 7.879, and the beta is 1 because it is the market. Our example ETF portfolio is earning 9.55 above the market, but the beta is 10.25 higher than the market. So our portfolio isn't as bad as we initially thought, but it still needs a little tweaking. We could change the percentages so that we weight the ETF assets with a lower beta or a higher average return or both, so that both the average return and the beta are positive compared to the market. Again, the goal is to outperform the market and ideally have a lower beta as well. So here's an example of a portfolio I made in Morningstar. It's a bit more complicated than our earlier one, and as you can see it has 7 asset classes including real estate and sector rotation. You can actually invest in real estate through mutual funds that invest in REITs, which I went over in a previous lesson about asset diversification. The sector rotation slice involves what I've been talking about for a while, buying sectors when they're low and selling them when they're high. Anyway, as you can see, the 10-year average for this portfolio is 9.59, compared to the S&P 500 at 7.61, which is a little lower from the 7.879 from before, because this portfolio is a few months old and the market data is from earlier this year. Anyway, notice that the beta is 0.98, which is lower than 1, so we're beating the market by 26%, with a 2% lower beta like a cherry on top of our cake of money. That's essentially how you construct and monitor a portfolio. You start with a model, tweak it to meet your needs, be conscious of the 10-year average and the beta, and check on it about every 6 months or so. I recommend using Morningstar, but you can use Google Finance instead if you don't mind doing some math yourself. If you're working with an advisor, they should have access to Morningstar through their firm. Whenever an advisor presents you with investment recommendations, ask to see the Morningstar report, just like you would ask to see the Carfax when buying a used car. You need to ask for the Morningstar report so you can see the averages compared to the index as well as the beta. If the advisor says they don't have Morningstar, doesn't know how to use Morningstar, or tell you that you don't need to see the Morningstar report, walk straight out the door and never go back there again, because you're either dealing with an amateur or a crook. Don't be afraid to walk away from an advisor. There are good advisors out there that would appreciate your business, so don't waste your time with the bad ones. I've had some guys in the comment section who are advisors comment on some of my past videos, and if you're a MGTOW financial advisor, go ahead and post your contact information. I won't delete your post as spam. Anyway, that's it for this lesson. I brushed over a lot of topics, so if you'd like me to elaborate on a specific topic, let me know what your questions are in the comment section. Thank you for watching, and I'll see you next time.